All right. As always, happy Friday, everybody. It is always a Friday on the Real Estate Investing Club podcast because that is when we record. So we're bringing that beautiful Friday energy to you. Today is a good day because we have Joel Friedland with us from Brit Properties. Joel has secured over 2,000. That's a big number when we're talking about industrial properties, leases and sales totaling over $250 million in acquisitions. Joel is the industrial guy. I have been super interested in industrial, so I'm excited to jump into this. Joel, thank you for hopping on the podcast.
Gabe, thanks for having me.
Absolutely. I told you before we got on here, we like starting with stories, hearing how people got to where they are. I know you got a good one. You started, 42 years ago? Well, at least that's what it says here. But in 1991, that's 43, almost 43 years ago now.
1981.
Even more. There you go.
Yeah.
So I'm excited to hear your story. How'd you get started in real estate?
So I'm turning 65 in about 2 weeks.
Mm-hmm.
And so I've been doing this since I was 20.
Happy birthday.
Thank you. I was 22. I graduated from the University of Michigan in Ann Arbor. And I was looking for a job. I knew I wanted to be in real estate. Growing up, there were some real estate billionaires living in my community where I grew up in Highland Park, suburb of Chicago. And it kind of looked like a good business to be in. And I was kind of interested in residential real estate even when I was in my high school years, because I was a landscaper. I cut people's lawns, and I actually built a big business by cold calling all the neighbors in my neighborhood and asking them, hey, how would you like to let me cut your lawn and trim your bushes and trees? And I got hired by dozens and dozens of homeowners over a 1 weekend cold calling spree that I did.
Nice.
Yeah. So I interviewed with a company called Podolsky and Associates, a fellow named Milton Podolsky, Milt, and his sons, Steve and Randy, and his daughter, Bonnie, and a guy that ran the company with them named Richard. So I met all these people when I was 22. And when I interviewed with Milt, he said, look, I have 84 buildings. They're all industrial. They're all syndicated. I've got hundreds of investors. It was 1981. There were 10 vacancies and business was bad. We were in a terrible recession and interest rates, ready? 17% on real estate deals, so 17% crazy. Mortgage rate.
We hear about everybody now, interest rates are 7-8%, and people are just like, we're never gonna, this is the worst ever. And I hear about in the 80s when it was 17, and I'm just like, that's a credit card debt right there. That is insane.
Yeah, it was insane. So it was hard to lease buildings. And I went and interviewed with Milt. He said, how would you fill up my 10 vacancies? And I said, well, when I was a kid, I cold called to get lawns to cut. And I suppose what I would do is I'd go to industrial parks where your vacancies are located, and I'd cold call all the industrial neighbors and see if they want to move into one of your empty buildings. He said, young man, you are so hired. So that's what I did. I became a more or less like a cold calling machine, and I ended up loving the business. I loved the Podolskys. I loved the 3 kids and the dad, Milt, and Richard, who trained me. And I went crazy doing deals. And about 10 years in 1991, I decided I wanted to start syndicating my own deals like the Podolskys did.
Okay.
I went to Milt and Steve and I said, would you help me? And they said, yeah, we'll put up some of the money. We'll introduce you to our investors. We'll help you decide if the buildings are good or bad. And I started syndicating with their help. They were my mentors. Nice. They were great mentors.
Yeah.
Every single day I learned something new from all of them. So imagine having 5 full-time mentors on your team.
Yeah. I was going to say, especially if they have that much deep experience in a specific niche, and that's the one that you're going after, that is, you can't get better than that. We always talk about the importance of mentors. So it sounds like you got a good situation going at the beginning.
It was so great. And between 1991 and today, we've acquired 100 industrial properties, and we've gone round trip on 81. We still have 19 properties now.
Very
I've
cool.
got 250 investors. 70 of them are active. The rest of them are from decades ago who are still with me, but who don't want to sell um, their limited partnership interests. They want to keep them. They're making good returns. But I went through some pretty tough times.
Hmm.
In 1990, there was a very bad recession. In 2001, after 9/11, there was a pretty bad recession. And in 2008, there was a hellish recession. And I'm not a stranger to losing money. I had of the 100 deals, of the 81 we've sold, we've lost money on 10.
Oof.
And I could give you the reason for each loss. You ready?
Yeah, let's hear it.
Mortgages, 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 mortgages. Lenders don't have a sense of humor. And when you get in trouble, the lenders put you in the workout department and they force you to either pay down the debt or to sell the property.
Mm.
And I'm seeing today that's happening to a lot of people because of their floating rate debt that can't be refinanced anywhere near where they had projected.
Yeah.
And I've learned that doing all cash deals is really smart for me and for my investor group because there is no mortgage. And if bad things happen, no bank is putting pressure on us.
Yeah. That is interesting. You are I feel like there's a very small group of investors who suggest not doing a leverage deal. Usually, I feel like people they want leverage, and usually it's the higher the better. If you can get a 10, put 10% down, people want to do these high leverage deals. But I mean, I'm risk averse. I don't like having risk, and the idea of doing a deal with all cash to me sounds great. The only problem I have is when you're approaching investors, your returns are going to be lower. And so how do you kind of walk that line when you're looking at new deals and you're thinking about doing all cash? Your ROI is going to be lower than somebody who's bringing that same deal to you, but they're going to have 30% down, 70% leverage.
Yeah, I'm going to give you an answer that you are not expecting.
Okay.
Okay. This is going to be maybe the most controversial thing that you've ever heard on your podcast, but um, I'm not against leverage
Okay.
as long as you do it and I don't. So it's
Okay.
okay with me for other people to use leverage.
Mm.
But I learned this is something I learned that it is maybe possibly a form of gambling
Mm.
to be a real estate investor with a lot of debt.
Yeah.
It's a form of gambling. And I'm very familiar with gambler mentality. And the reason I'm familiar with it is because I know people who have gambling problems in the stock market
Mm.
with options, with
Oh yeah.
Bitcoin,
Yep.
and with real estate. And I figured out a number of years ago that I had a gambling problem because I was putting money, my own and my investors' money, into deals that were subject to loans,
Mm.
mortgages,
Mm-hmm.
and that were subject to all kinds of risks, especially vacancy in industrial. Usually, if you do a single tenant acquisition and the tenant leaves, you're 100% vacant. You can't pay your mortgage, you can't pay your taxes. If you have a big loan, you're behind the eight ball.
Yeah.
And there's actually a book called Behind the Eight Ball, which is about compulsive gambling.
Mm.
And I read that book and I figured out that many real estate investors are gamblers. And there's nothing wrong with that, by the way. I'm not criticizing it. You're a young man. How old are you?
I'm 37.
Okay. You are a young man. I would expect that you would do deals with debt. I would expect it. If you didn't, you know, you'd be doing something that didn't feel right. It's like it would feel too secure and too safe. But in my own case, I can't gamble
Yeah.
because I went into emotional downturns with the economic downturns
Mm.
when bad things happened. And now that I'm in my 60s and many of my investors are in their late 40s, 50s, 60s, 70s, even 80s and 90s, I don't want to make a deal where I represent a group of investors in something that I consider to be gambling.
Makes
So
sense.
I'm just unique. Let's say there's 4,000 syndicators in the United States who have $50 million or more of assets under management. I
Is
know
that an
there's
actual statistic or?
it's pretty close. Yeah, we
Okay.
we we,
Okay. I
we
didn't
did
know
a
that.
study. It's pretty close.
Yeah.
Um, I would say that there's only a handful that do all debt, all cash deals. I know of a couple others. It's not right for everybody, but for me, by the definition of gambling, for me, I can't gamble like a younger person anymore because I can't afford A, to lose my money, B, to lose my investors' money, and C, to go into a nosedive emotionally and be in a depression because of how bad I feel and how ashamed I am.
Yeah.
And at my stage in the game, I'm not going to gamble. So
Yeah.
the all cash, no debt deal for me is good for me and for the people who are sort of my followers, let's call them, or my investors who say, yeah, Joel, I'm with you, man. I don't want to lose my money either. If there's no bank, how do we lose? And so I have a group of those people. It's a small group. It's only about 70 people
Okay.
because they're hard to find. It's hard to find people that like this philosophy. But I'm not against you borrowing 90%. At 37, man, go make a fortune. And how do you make a fortune? You
By
use
leverage.
leverage.
Yeah.
So so that's great, but when you do it, you have to know that you're gambling. You can't say, "Oh, there's no risk here."
Yeah.
There is risk there. There is.
Well, I especially like that you mentioned the emotional side of it because the stress in investing really does. I mean, it comes down, well, one, for the liability. You always have liability when you own a property because who knows what can happen. But that is something that can't be changed. But the second biggest stress is not being able to hit your, to cover your costs. And the biggest cost is going to be your mortgage, especially if it's high leverage. And so if you can remove that, you can remove a significant portion of the stress that you're going to be experiencing, which, we really, all of us, we just want love and happiness in our life. And so if that's your goal, I understand why you would do that. I understand why you would go debt free, and raise from investors. And I also see why an investor, if you position the investment as, we want stress-free investing. We want you to feel that you're not, if you have a low risk tolerance, I am the syndicator for you because I'm going to be buying these deals 100% cash down. And so there's not going to be a mortgage. And so you can feel more secure that your investment is not going to be lost. You can show them
Yeah.
the underwriting exactly. So,
Yeah, but you're right. I mean, you will make more if deals go well with leverage. You'll make a multiple more.
yeah.
I can't make 20 and 30% IRRs with all cash deals
Yeah.
because the value of the buildings, we buy them for more or less market value. You can't
Mhm.
buy too many things for under market, maybe a little bit. But if you buy a property and it goes up on average 3% a year, 4% a year, and let's say our cash flow is 7% a year, and let's say that cash flow goes up. So over a 10-year period, maybe you average 8.5% cash flow. And maybe over that same period, the value of the building on an unleveraged basis goes up 3% a year. It means that you're making 11 or
Okay.
12%
Yeah.
overall, including your appreciation. I'm okay with that. And if I
Yeah.
get a home run, maybe it's 16. But I'm not shooting for 20s because I can't make 20s with 7 or 8% cash flow because what it means is I have to make 12% on the appreciation portion to get my IRR up to 20.
Mm.
And in order to make 12% in a property that only goes up 3 or 4% a year, which is what historically real estate goes up, you got to have leverage. You got to be 4 to 1. You got to be 75% loan to value ratio.
Yep.
And so that's why you're right. It's not as lucrative if it works. But Warren Buffett's got a saying that I really love. It's a slogan, so to speak. Rule number one is don't lose money. Rule number two is go back to rule number one.
Smart man. You can't lose if
Because
you're not losing money.
if you do 5 deals and they're all highly leveraged and you lose all your money, which can happen on one of the 5 deals, the other 4 are going to be in the single digit returns when you average them all out.
Yeah.
Your overall return is not going to be 20%. But when the market's going up, so since 2009, I've watched the market do nothing but go up, especially in industrial, especially the last 5 years. But
Yeah.
that's not forever. There will be a downturn. And I'm prepared for that because of the fact we've got no mortgage.
Yeah. Yeah. I've been you know, I wish I had a crystal ball. Every year I keep thinking like this is the year it's gonna go down. This is the year it's gonna go down, but it just keeps going up. I don't know what the deal is, but hey, that's why you underwrite conservatively. And for you, that's why you buy with no debt. You
Yeah.
mentioned in there that you generally buy from market price, which is surprising to me. I feel like if you're buying all cash, you would need to be buying at a discount. So tell us about your acquisition strategy. How do you find the deals and what are you looking for when you buy them?
Yeah. So we only buy in Chicago right now. We got out of our other out of state deals. Chicago is a gigantic industrial market. We've got 15,000 industrial buildings. It's the biggest industrial market in the country in a relatively compact area.
Hmm.
There are markets that are bigger when you look at the giant metros, but it's not like Chicago where I can be anywhere from where I live in 40 minutes.
Okay.
So the 40-minute radius, there's 15,000 buildings. That's 1.5 billion square feet. I don't
Jeez.
need to get on an airplane and go learn Indianapolis or go learn Dallas. Someone else is the Joel of Dallas. I don't
Hmm.
need to go there and have them know everything and I know nothing and have a learning curve. I know you've talked about this too. You like the idea of laser focus on one market, and I've heard you say that. And that's why we do Chicago only.
Yeah.
So we know the values of every building. We know every street. With industrial, it's impossible to buy below market.
Gotcha.
It's not a mom and pop business. It's a
Right.
business of people who own industrial buildings are incredibly wealthy. They own a company that makes millions of dollars.
Even with small bay industrial
We
or
don't do small bay industrial.
okay. Okay.
We
So you
can't stand,
guys
we can't stand small bay industrial.
okay.
Again, it's something good for other people,
Yeah.
just not us. We like established companies as tenants,
Mm,
make money, and who are going to move into a single tenant building and stay there for 20 years,
gotcha.
where the rent goes up every year and they never leave.
Yeah.
The small bay stuff, you got credit problems, you chase tenants for payment of rent. There's startups. We don't deal with startups. We're too old for that. We deal with established companies, single tenant, who stay and stay and stay. No one's going to sell us a building for under market.
Yeah.
They're too sophisticated.
Yeah. Too efficient, too
And
sophisticated.
there's 300 industrial brokers in Chicago.
Wow. For
Yeah,
15,000. That's crazy.
yeah, 300 active industrial brokers. And when someone has a building, they're already getting cold called by multiple brokers who work in that particular geography.
Yeah.
So here's one. I went cold calling. I still cold call to find buildings. So there's a street here called Ivanhoe, and it's in a town called Schiller Park. And I went to Ivanhoe Street and I walked up and down the street where there's 7 industrial buildings. And I stopped in at every one of them myself. And I found 2 potential sellers on the street.
All right.
One potential seller said, I walked in. This is a great story. I walked in and I said, I saw this guy, this man, just by the front door. And I said, "Hey, I'm here to see the owner of the building." And he said, "I'm the maintenance guy. The owner's in his office." I said, "Okay." I said, "Well, I'd like to talk to him about maybe buying this building." And he said, "Let me go check." So this guy walks a few feet to a private office open door and he comes back out about a minute later and he says, "Bob can't meet with you now. He's on the phone. But I don't think he wants to sell. I just don't know." So I
This is going to be
said,
Bob. I can already tell.
so I said, so I said, "Is Bob in his office?" He said, "Yeah." I said, "How long do you think the call will be that he's on?" He said, "I don't know." So I said, I knew Bob could hear me if I yelled loud enough. I said, "Okay, well, tell Bob that Joel came by and is looking to buy every building on Ivanhoe. I'm going to try to buy every building on this street." And it didn't take 30 seconds. And out from that office comes Bob.
There you go. You just
Bob
got to have
says,
the right message.
and Bob says, "That's music to my ears." He says, "Hi, I'm Bob, and I own the company, and I would like to sell the building."
There you go.
And I said, "That's great." He says, it was Easter weekend. So it was a Friday of Easter weekend. He says, "I'm going home for Easter weekend. I don't want to deal with this. Let's talk on Monday." So I called him on Monday after Easter. And I said, "You want to sell the building?" And he said, "I do, but I have an industrial real estate broker that's represented me since I bought it 22 years ago."
Wow.
So the next day, I get a call from that broker who says, "I represent Bob, and I'm going to put the building on the market, and we're going to try to find a buyer at the highest price. And here's how much he wants for it. He wants 2 million." I said, "Okay, I can't pay 2 million." He said, "Well, then maybe you won't be able to buy it." I said, "Well, then maybe I won't." And this broker and I have known each other for the entire 42 years I've been in the business. His name is Stu. So I said, "Stu, look, if he wants to sell it all cash right away, 30 days, I'm the buyer." And Stu said, "We're going to do a process and put it on the market, and we'll let you know in about 3 months."
Okay, Stu. All right.
So I'm not going to steal a building from a guy in
Yeah.
our market. The guy owns a company. He makes money. He's been there for 22 years. He's not going to give it away. It's not like stumbling into a mom and pop, as they say, owner of an RV park or
Self storage
self
facility.
storage like what you do,
So,
because it's an efficient market. There's too many people who know too much, and there's comps, and the comps are up and down every street. On Ivanhoe, there are comps in the next street over, which is River Street. There's comps in the next street over, which is Winona. There's comps, and then Ainsley. There's comps.
so
So
we usually get discounted properties due to mismanagement. That's probably not the case in industrial, right?
no, there's no mismanagement.
Yeah.
There's no
Okay.
such thing as mismanagement of industrial. Well, there is on the multi-tenant stuff that you were talking about that I don't buy.
Gotcha. Yeah.
That's where we
Single
can.
tenant, I would imagine it's pretty simple to manage and make sure they're paying, make sure that, well, I get are they triple net? Is that how most of these properties are?
Not exactly. Usually the landlord is responsible for the roof and the structure and
Hmm.
replacement of old HVAC units that die.
Gotcha. Gotcha.
So
Okay.
it's not exactly triple net, but it's
Gotcha.
close. We get net rent. They pay the taxes, the insurance, and the maintenance,
Hmm.
and they call us when the roof leaks.
Fair enough. You gotta earn your pay there.
Yeah, no, but
Um,
you're in a different business because there's not like 7 self-storage places on the same street where the owner knows all the other owners and understands the comps, because the last one that sold is public information and they have a broker who's telling them everything. It's a different world.
yeah, yeah,
Makes
that
it
makes
much
sense.
harder for us.
Awesome. Well, hey, we're running down the initial period here, but before we move into the quick question round, I just wanted to ask you for people out there, maybe they've done some flips, single family stuff. They're looking to get into commercial. They're interested in industrial. What are the biggest pieces of advice you can give people who want industrial as their asset?
There's only one thing to do. There's only one answer. Find an experienced industrial person and get to know them and have them be your sponsor or your mentor.
Great advice. Great advice. Couldn't have said it better myself. All right, and that I'll take that as the opportunity to segue us into the quick question round. Are you ready?
Yes, sir.
All right. It starts with education, could be books, could be movies, could be whatever. I just need two recommendations, one for general life wisdom and then one for real estate.
The general life wisdom book that's my favorite is called The Four Agreements by Ruiz.
Yeah.
Love it. It's got four pieces of advice and it's how to live your life in a better way. And I love that book.
Yeah. One of my favorites too. Really good one.
The real estate book that I like is this one. It's by my friend Mike Morosky.
Okay.
He
Exit
is a
plan.
syndicator. He's from Chicago. He now lives in Colorado. He is one of the most trying to fix my camera. He's one of the wisest people I know in real estate. He's my age. He's in his 50s. He's not quite as old as I am. But I love the book. It's about all the things he's learned in a career of being a real estate syndicator.
Perfect. And the name of that book was Exit Plan.
Exit Plan by Michael Morosky.
There you go. All right, next question is for your younger self. So let's go back many, many years, back to the Joel who was, let's go back to that Joel who was just starting calling the people in his neighborhood for his landscaping business. Go back to that version of Joel, look him in the eye and give him one piece of advice moving forward.
Oh man, pay attention to the details, Joel. Don't say I'm a big picture guy. That's stupid. That was so stupid. I'm a big picture guy. I'm the sales guy. If you don't run your details in your back office really, really impeccably, good luck to you.
Yeah.
Yeah.
Good advice. Good advice. It is, especially when you do tend to, there are certain orientations with how people deal with information. And if you tend to deal in the verbal side of things, you're a bit less numbers oriented, then you'll think that you're a big picture person, but you're absolutely right. If you just relinquish control for every detail, then you're going to have a hard time in real estate. That's for sure.
There's a guy named Jay Connor. I was on his podcast about a year and a half ago, and he said he's got this great Southern accent. He says, "To be successful, you got to do the math." Do the math.
Touche. All right, moving us on to the next question. This is about the U.S. It is a big play slot opportunity. Give me the single metro you're most excited about investing in today.
Well, as a limited partner, I love the Smile States. I like where the weather's better than here in Chicago. So
Florida,
if I'm a
Georgia,
limited
Texas.
partner, I want to own some stuff in some of those markets where people are moving to from the East Coast and from the Midwest. But Chicago for industrial is as good as it gets. And so I'm really excited about two places. Doing my own deals here where I'm the sponsor and I have investors, Chicago. Being a limited partner, North Carolina, Charlotte, Raleigh, Durham, Nashville, places in Florida, places in Phoenix. I love Salt Lake City. And there's some places that I just love. But I want to be with an expert in that market, not someone who occasionally or once does a project there.
Yep. That's funny. So every Friday we do 3 episodes. You're episode number 3, and every single person that's come on this morning has said North Carolina, as the market that they're most excited about investing in. So maybe that's a sign. Anybody out there, if you're trying to choose a market and you're not wanting to invest in your own backyard, you should check out the Carolinas. All right. Next question is about finding deals. It all starts with reaching out to the seller and penning that purchase agreement. So, what is your favorite way to generate leads and find new deals?
Cold calling. We cold call every day. There's 3 of us who do it every day, and we each are responsible for making 1 offer a day, no matter what.
No shit. One offer a day. That's great.
One
Actually,
offer a day.
that's
Three of us.
exactly
So
what
that's
we
three
do
offers a day. That's 15 offers a week.
for
And
just for industrial.
yeah,
Wow,
yeah,
good job. That's
yeah.
5 offers a day. When we were really growing the self-storage portfolio, that is the number that I was doing. Not 5 offers a day, 5 offers a week, which equates
Yeah.
to one a day. And I bought, let's see, I got into self-storage, and then within a year and a half, I had bought 5 facilities. And that's how we did it. We just 5 offers a week, and if you get those out there, eventually you're gonna hit some wins. So that
I
is
have a great saying. It works if you work it. It doesn't work if you don't work it.
yeah, and then it's so true, and it's so frustratingly true, because sometimes you'll think, oh, luck is not on my side, and then you got to ask yourself, are you hitting the numbers? Are you making those calls? Have you gotten the offers that you said you'd get out? Have you gotten them out every week? If you haven't, then there's your answer. You just
Yeah,
gotta.
yeah. I've got an investor from Montreal who's one of my favorite people in my group, and he says luck is not a good strategy.
Yeah, it's nice when it's on your side, but the only thing that you can control is volume, and so just keep the volume up.
Yes, yes.
All right. Next question is about lessons learned. Not every deal goes the way that we expect it. Sometimes we get into a deal and things go a little sideways. We never want it to go sideways, but when it does, that is when we learn our biggest lessons. So, what was a deal that went a little sideways for you, and then what was the lesson you pulled from it?
Well, I have two deals that were done at the same time. I had a partner in my real estate business, Big Dave, and Big Dave said, "Hey Joel, we do industrial uh, and we buy existing buildings, but I think we should branch out and buy some retail land and be retail developers." And I said,
Mm,
"Dave, A, we're not developers, and B, we don't do retail." He says, "Come on, let's do it." And he brought two deals, and he was so convincing, and he was my partner. I didn't want to fight with him. I said, "Yes." We lost more money on those two deals than anything that I've ever done. We're not developers. We don't do retail. As you said, stay in your lane. And we didn't stay in our lane.
yep.
So those were the bad ones.
Yep. Once you pick a niche, stick with it. It's so tempting to look at other assets, because that's what real estate's exciting, because there's so many ways to do it. But when you get out of your lane, that's when you make mistakes. Once you choose a lane, just stick with it, and that's how you're going to find success.
Yeah, it's like dating or being married or anything. The grass is always greener on the other side. You think, yeah, I love my wife, but look at that one over there. She's a better wife than my wife. And you just don't know about how crazy or bad the one that you think is perfect really is.
Yep.
And so stick with your thing and don't let that shiny object syndrome pull you away from something good that you already have. That's how
Put
I
the
look.
blinders on. Exactly.
Yeah, the blinders.
All right, that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you, learn a little bit more about industrial. So this is a two-parter. Where can they find you, and then what can they expect when they reach out?
We are at britproperties.com, BRIT, one T properties.com. There's a lot of information about our investments. We have a $25,000 minimum for any deal with investors who join us. Our average investment from each person is about 80,000. We have a lot of people who put 100,000 in per deal, and then we've got some who are very, very wealthy and they just want a lot of properties. And they do 25 or 50,000 per deal. So they will find that we have 3 or 4 opportunities all the time, property by property, 7 to 8% cash flow, and it's really fun to do these deals where we feel like we've got so little risk.
Do you
But
guys?
there's still risk. There is risk.
There's always risk. You can't get away from risk, but you can reduce it for sure.
Yeah.
Do you guys? I didn't ask. Do you guys do the syndication or fund model?
We do syndication one by one.
There you go. All right. Well, hey, Joel, that wraps it up. Thank you very much for hopping on the show.
Thank you, Gabe.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you want to support the show, leave us a review or just share the show with your friends and family. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.